Hello, and welcome to the property market update for Western Australia from realestate.com.au. I'm Luc Redman, an economist here at REA Group, and I'll be taking you through the property market update, what's happening in the economy, and how we're kind of seeing the property market right now. To that end, we'll start with economic conditions, then we'll move into current housing market, then we'll look at investor activity and budget changes, which is a very topical area at the moment. And finally, we'll finish up with a bit of an outlook of how we expect prices and the economy to look over the short term. Starting off with economic conditions, inflation's been a pretty big story recently, and that is unlikely to change over the next 6 months. What we're currently looking at here is the Consumer Price Index. So that's essentially the basket of goods that households consume and how the price changes in those kind of affect how the prices change in those. And that's basically our preferred measure of inflation within the economy. And there's two main series that get produced out of that. There's headline CPI, which tends to be what gets reported in the news a fair bit. So headline CPI is that red line that we're seeing here on screen. So basically that red line is what households kind of feel. That's kind of the fluctuations and the volatility that exists within headline CPI. So when prices are spiking, households are obviously spending a lot more of their income to purchase the same amount of goods. And when they drop, they're spending a lot less of their income to purchase the same amount of goods. Looking at the trim mean, which is that light blue line, that's the RBA's preferred measure of inflation. So the trim mean basically takes the top 15% of price movements and the bottom 15% of price movements within the CPI basket, and it removes them to essentially get a core 70% of what's essentially happening within the economy. That kind of removes the volatility that can occur. So what you kind of see here is when there's a large spike within those prices or a large drop, you kind of see a lot less volatile movement in the trim mean. So it's a bit more cuts through the noise. So when things like fruits or vegetables can spike due to seasonal events or cyclones and things like that, and we see large price increases for a short period of time, the trim means idea is to try and remove that sort of fluctuation. Looking back at the chart, essentially that grey area is the RBA's target band that they're trying to get inflation to for the economy. So the light blue dash line, that's basically RBA's forecast for trim mean, and the red dash line is their headline CPI forecast. That comes out when they sometimes release their decision on where interest rates are going to go, and that's kind of their view of how they expect inflation to evolve over the short term to medium term. Ultimately, these forecasts are telling us that at least until about early to mid 2027, we're not going to see inflation return to the target band. So we've got about at least 6 to 12 months before we're kind of seeing inflation come back under control, pending any other sort of economic shocks like is happening in Iran right now. That essentially is like an assumption for the RBA of where they view interest rates going, and we'll get a bit more into that later. The main reason why inflation still kind of remains quite high in Australia is mostly down to domestic factors. So what we're kind of looking at here is that line, that red line that we saw before in the last chart, headline CPI, broken out into what is referred to as tradables versus non-tradables. So tradables, the red line, non-tradables, the red line, that's kind of domestically driven prices. So things like rents, electricity, pharmaceuticals, hairdressing, those sorts of things that have a lot of domestic inputs in them. That's kind of like a key driver there. And that makes up about 2/3 of the basket. Tradables, that light blue line, they're more internationally driven prices. So when you consider those internationally driven prices, tradables essentially are things like TVs, cars, those sorts of things. And what we see is coming out of the pandemic, we saw quite a high increase in those inflationary prices. And then that came down as a lot of supply chains, particularly for tradables, quite dramatically as supply chains returned and production came back online as restrictions eased. The RBA saw a lot of that at a headline level and thought, at least with non-tradables, they were trending in the right direction to be within the target band. But ultimately, since they eased interest rates, both non-tradables and tradables have gone up quite a bit in recent times. And with non-tradables sitting at about that just a bit below that 5% annualized price growth, which for 2/3 of the basket is quite dramatic and quite high. The light blue line, you see that big spike recently in tradables. That's basically from the Iran war and the jump in oil prices that we saw. And the drop back down is the recent easing that we've kind of seen in oil prices, and also combined with policy responses that, like halving the excise and other sorts of tradables that have reduced the cost of trade. That ultimately has led to the RBA increasing interest rates. So what we've kind of seen here is mortgage rates for a new owner-occupier variable rate. And basically what we're looking at is it's reached an equivalent to a recent high. So 6.23% was what it was in May for the average new owner-occupier variable rate across the Australian financial markets. And that's about equal to what we saw when interest rates peaked in about 2024. When you look at it in the recent history, it's actually quite a high jump from the very low interest rates that we saw during the pandemic and even prior to the pandemic. So we're at a rate that's about equivalent to 2012, 2011 interest rates, where since then we've seen quite a trending down of interest rates up until quite recently, where we've had a lot of supply constraints within the economy to meet that demand. Hence, the RBA has increased the interest rates, and we see the cost of borrowing for households and businesses increase with that. That is expected to increase the unemployment rate, but ultimately the unemployment rate is actually still quite at a historic low level. So unemployment rate and inflation have an inverse relationship. So when one rises, the other one falls. So when unemployment rises, inflation tends to fall. When inflation rises, unemployment tends to fall. And that's kind of the relationship that the RBA tries to control. And so that they can try and meet an equivalent of low, stable inflation and full unemployment as best they can. When we take a broader view of unemployment and the unemployment rate, that red line that we're looking at here since the 1970s, we're essentially still quite at a very low level relative to recent history. So there's been very strong labour market gains that have occurred, and that meant that there's a bit more of a shortage of labour for firms to use. So that's bid up wages as well, which we've kind of seen. A lot of that has been driven by the non-market sector, so a lot of public sector and non-market sector equivalents demanding more labour as demand for those services has increased. And essentially, that's meant that we've had a bit stronger wage growth. But when you consider wage growth, you need to consider it in the context with inflation, which is real wage growth. And essentially, that's pretty much been flat or negative or around about that mark for the Australian economy since COVID. And ultimately, households have felt that pinch, and budgets haven't really grown in terms of real wages or real consumption. The blue line that you see here at the end of it is the RBA's forecast of unemployment. So as they expect inflation to come back to target band and drop, they expect unemployment to rise. Those conditions, though, that strong labour market has kind of supported a fair amount of economic conditions, mostly in a lot of ways from hiring in the non-market sector or mostly the public sector and a bit of the private, up until quite recently when we've seen data centers come in with quite a large investment and demand. So what we're looking at here is GDP growth annually as the dark line across each quarter, and each of the bars is essentially the contribution from each sector of the economy. So net exports, our exports, that the things that Australia exports, less the things that Australia imports, plus some other things, and the private sector in the light blue and versus the public sector in the purple. So the public sector has been relatively consistent and strong, and has been a key driver since about just before COVID, but ever since COVID, of GDP growth in Australia. We saw quite a big shock during around that time when COVID happened to the private sector, which a lot of policy responses came in, and we saw a lot more growth in that sector before we kind of have reached roughly back towards a bit below, but roughly back towards our long-term average after the shock. The last 4 quarters that you see on the very right there, where you see an increasing size of the private sector in Australia, that's pretty much all driven by data centers, or mostly driven by data centers. There's a little bit of excess public sector demand, which is continuing to occur, but ultimately that's kind of been the main driver. So a lot of other private sector investment or growth hasn't really occurred outside of that. Looking at WA now and the population growth, that's been quite a key driver of the housing market and economy in WA. That combined with mining and elevated commodity prices. But essentially, Western Australia's population growth is quite cyclical, and it really depends on how the mining activity is going within the state. So what we're looking at here is the red line on the left is WA's annual population growth, and what you see is during the mining boom, there was quite strong population growth as above the Australian average. When that kind of finished around 2016 and came off, we actually saw quite slow population growth for quite some time below the national average. And then during COVID, didn't have as much of an exodus as other states kind of did. And essentially, mostly because the border was closed and there wasn't a loss at all, or there was more of a desire for people to move to WA. And then coming out of those restrictions, there was quite a big jump to where we've come down to a bit more towards that 2.2% and a bit more of the long run average, or a bit closer to the long run average of WA, still above that national rate. So population growth in WA is still really strong. That's underpinned by quite strong mining activity. The components of the population growth tell quite a similar story. So during the mining boom and since 2000 and since 2000, and you see during the mining boom when that accelerated, population grew quite significantly within WA, and we see that in the uptick in the net overseas migration and interstate migration. So more people moving from other states of Australia to Western Australia, and more people moving from overseas into Western Australia than people leaving Western Australia for overseas. Natural increase, which is basically births less deaths, has kind of remained relatively consistent over that period. But what we see is when the mining boom finished or came off, we saw quite a drop in the net overseas migration and the net interstate migration, so people leaving WA in terms of net interstate, and a big slowing of overseas. And then during coming out of COVID, we've actually seen a big reversal of that and a big jump up in the overseas migration demand. Moving towards house prices in the established market. So prices in Western Australia really broke away in 2022. So they kind of tracked it along, at least in the early part of COVID, with national prices, and ultimately just stretched away after the fact when borders reopened and things came to normal, and the mining activity within WA presented higher wages and a desirable lifestyle for people to move to the state. The regional rest of WA areas has actually grown a little bit more than Perth, but both of those have more than doubled since March 2020. That is the highest out of any city for Perth, with the most growth, with Brisbane being second, slightly below Perth, but still with quite strong price growth. Well and truly above where moving to house prices in the established market now. And prices in Western Australia really broke away in 2022. So they were kind of trending since 2020 with the national average as the lockdowns and restrictions occurred. And they've really run away since then as a lot more population demand has returned to the state over what has kind of occurred nationally. And people moving interstate from the rest of the country have been quite driven towards Perth and WA for higher wages and lifestyle opportunities. Rest of WA has actually outgrown Perth marginally, but both regions and the whole state has had about a doubling of home price values since 2020. That's a more than Brisbane and Queensland, and kind of leads the nation in terms of price growth, and well exceeds Sydney and Melbourne markets, where they've been a little bit more subdued in growth and even more flat in Melbourne recently. We kind of really see the picture of this in terms of when you split it out from houses and units, and looking at Perth here. So houses maintained pretty strongly with the national, and that kind of ran away quite recently and has been the key driver of growth within Perth. But when you look at units, it's a little bit of a different story. They lagged a little bit initially, as we saw quite a strong growth kind of return to or continue, at least in houses on the left here. And then on the right, you're kind of looking at the units, and they did accelerate as kind of prices started to bite a bit more. and people started to look at substitutes for dwelling services and housing. And they've kind of moved away from purchasing a house because of affordability, a bit more towards units. So that's why you've kind of seen a bit more of an acceleration from 2024 roughly onwards. There's been a little bit of a downturn since then. There's obviously there's been three interest rate hikes since the start of the year. There's been the budgetary changes, which we'll get to later. And that's pulled back a little bit of the price growth that we've kind of seen. And prices are a little bit more subdued than what they were. But ultimately, they're still well above 2020, 2024, 2025, and really quite accelerated, which for a normal holding time of an asset, of a property, which is usually between 7 to 10 years or around about, that's quite strong price growth over that period. There's not too much of a difference in terms of price tiers, but there is an interesting story around the unit versus houses within Perth. So what we're looking at here is price tiers and price growth within those price tiers, so higher, medium, and low. And essentially the higher end experienced the most amount of growth when Perth property prices were a lot more affordable than, say, in a Sydney or a Melbourne and those other markets initially. And then that grew quite dramatically until we kind of got to the point where we've kind of seen the lower end price growth grow a lot more than the mid and the high. Moving to rentals now, and rental availability in Perth remains really tight still. It's eased a little bit in the rest of WA, and ultimately is a little bit higher than capital cities and regions for the rest of WA, but Perth is still a fair bit below those. So it's sitting at around 1% versus the rest of WA, which is about 1.7%. That a tight labour market or like a high stress labour market is kind of considered anything below the 2% mark. So with that, we're kind of expecting that rental price growth will mostly continue over the short to medium term, and ultimately supply is the only thing that is going to relieve this stress for households. So we can kind of expect a continuous increase in rents over the medium term. Looking more towards rents now, and ever since 2019, at the start of 2019, it's nice to take a longer view of this, but this is asking rents in Perth, rest of Australia, capital cities and regional areas. And prior to 2019, they were both, Perth was certainly below the capital cities in terms of rents. Rest of WA was about on par, but a little bit below the regional areas. And ever since then, they've both exceeded those comparable regions. And in fact, rest of WA is above the other capital city average, and Perth is well above. So rental affordability is quite expensive right now and quite high, sorry. Rental unaffordability is quite high right now. And rental growth is probably going to continue at least over the medium term within the state, as population demand is still really strong and supply isn't necessarily matching that demand. Looking at listings activity, we're still seeing quite strong listings activity within Perth, and that's kind of sat around about last year's average last year's listings activity by each month, and above the average over that period as well. Properties are selling below property. So what we're looking at here, sorry, is properties that are selling below the asking price. They have increased quite dramatically in recent times because of interest rates and then the budgetary changes. But when you take a longer term view, which is the dotted line you see on the two plots, so on the left is Western Australia and on the right is the national. The dotted line is essentially the long-term average over this time period. So whereabouts we're kind of like, how are we looking compared to at least the last 11 or so years? And when you look at WA, quite a lot of properties are still selling above asking price. So around 65% or two-thirds are still selling above the asking price, original asking price. Those that are selling below have increased from about the low of 15%, but ultimately still a lot of properties in Western Australia are getting a price point above what they're kind of asking initially, and still well and truly below the long-term average. And that's the same nationally still. We'll see how this unfolds over the short term, but ultimately, as we expect potentially for interest rates to ease into the future, that's potentially the case that we're going to see that below the asking price continue to drop, as we still have quite a shortfall in supply. Moving over to investors and budgetary changes. So there's been two major policy shifts that have been covered quite a lot recently in terms of federal government policy. Um, Over the short term, we expect that they will increase the proportional number of owner occupiers. So the demand, at least over the short term, in terms of purchases, are probably going to come more from owner occupiers than from investors. But focusing on the budgetary changes and just laying it out briefly. So the capital gains taxation is changed and it'll use now a different discount methodology, reverting back to its old indexation model in financial year 28. Combined with this, there's going to be a minimum marginal tax rate of 30%. And the minimal marginal tax rate of 30%, the aim of that has been to try and stop what is unrealized strategic realization of capital gains, which are things that kind of happen more so in shares than in property, where it's usually a large one-off profit purchase in property or sale. But in shares, you can obviously realize a certain proportion of shares within companies over time to pay less tax. And that's kind of the idea of the tax rate. And that still does affect property. Transition to the new methodology will occur on July 1. And any unrealized gains to that point can be determined under two methods. So when you realize the gain on the sale, essentially there will be either you can claim a proportional pro rata share of holding time. So say you hold the property for 5 years under the 50% discount, and then you hold it for 5 years under the indexation method. Half of your gain can have the 50% discount, and the other half can have the indexation method when you sell. The other component of that is you can then either get it assessed at value. So essentially, you'll get a valuer to come to the property and say, this is how much it's worth in terms of the current value of the property. And that will basically mean that the value of the property is determined that that's how much from the purchase price to that valuation is how much of the gain will be 50%. And then anything above that amount from there will be subject to indexation. New builds can choose from between the two methods, with the principal place of residence still CGT exempt. And negative gearing has changed as well, and it's shifted from deducting losses from current income to deducting losses against future property income gains for established property. So that's more of a portfolio approach. So you can actually you can do it as an individual property holder, but if you have portfolio of properties and you're making a loss on those property incomes currently, but in the future you make a gain, you can offset those future gains, property income gains, against those losses so that you're not paying tax on those. Commercial property and new builds can still access the old negative gearing rules, and purchasers prior to budget night are still able to claim negative gearing. AUSTRAC anti-money laundering requirements came in on July 1, and real estate agents now must verify client identities and assess financial risks and monitor for suspicious activities and report those as they need to. And that's kind of to prevent money laundering occurring within the economy that currently exists. Looking at the CGT discount, so it's more technical than arbitrary and can sometimes favour some residential investors. So what we're kind of looking at here is residential property investor capital gains treatment at a national level since 2016 to now. And basically what we're currently looking at is the proportion of sales within each quarter that would have had a lower tax bill when they realised a capital gain if under the indexation method versus the 50%. So ultimately, the 50% discount provides the majority of property investors a lower taxable tax bill. Sorry, but that's not true for all investors. With about 25% or thereabouts of those properties that having more favourable treatment under the indexation method than under the 50%. Looking at investors now, and investor loans have grown steadily in Western Australia since about 2020, and they've kind of near their peak, at least until March of this year. And that's been a key driver of demand within the state, as well as the population growth that's kind of occurred. That in turn has meant that despite a diminishing amount of share of investor sales for sale listings since 2021, there's been quite a large uptick in new for sale listings by investors within the market, but it's broadly aligned with the rest of Australia. So it's nothing too unique in Perth. But any investors, anyone that's looking to sell over the short term, chances are that because of the higher proportion now of investors investing into WA over the recent times, that they're probably going to be an investor over an owner occupier, and an owner occupier is probably going to be the person purchasing the property, given all of the tax changes and current market settings. Moving over to outlook. So looking at the current dwelling completions. So on the left here, we have the Australia's dwelling completions, and on the right, we have Western Australia's. We're still not quite building enough houses or units to meet our current national cabinet target of 1.2 million homes. We see that as a horizontal line on each of the axes. So each state kind of has a rough housing accord target that they must try and deliver. And that's basically over 5 years, we need to hit those targets. Right now, Australia nationally on the left is well and truly behind that. And WA is a little bit lower, but a little bit below it, but not quite as low as what we're seeing nationally, but has quite a big deficit that needs to be made up. Ultimately, that's going to mean that there's still excess demand occurring within the market. And as long as there's too much excess demand and not enough supply, we're going to see price growth continue over the long term. And that's going to be the same pretty much nationally. Looking at the RBA cash rate. So what we're looking at here is the cash rate in the red line over time and in recent history. And we're looking at three kind of forecasts. So economists kind of disagree where the cash rate will go over the short to medium term, or at least the short term. But inflation data over the next couple of months will kind of really determine who's going to be correct and who's the more correct right now. So Westpac is in the green in the dashed line, and they're basically saying that they reckon interest rates will hike once or even twice more. The light blue line just below that, which you see in the light blue dashed line, that's the RBA's actual forecast view that they've released of where they expect interest rates to go. And they still think that it's going to be a little bit higher to get inflation back to where they expect. Market Economists, which is essentially a survey that the RBA does of where everyone expects interest rates to go within market economists, and kind of gets a general picture of the sentiment. They basically expect that to remain flat before cutting into 2027. Westpac also believes that cuts will occur around the same time, but thinks that the stickiness of domestic inflation that we saw earlier is going to require some more contractionary movement, i.e. putting up interest rates a little bit more to kind of get to that target. Whereas market economists kind of think there's enough slowdown in demand in the economy that it's going to be enough if we just hold interest rates steady. Taking all of that as a broad picture, REA, we kind of still think that that's a fair amount of noise. And basically over the short term, we're going to probably still see some downward pressure on prices. But ultimately, that shortfall in supply and given with demand is going to mean that price growth is going to return back into the future. So for 2027, we predict that we forecast out that basically every capital city will return to some level of growth, albeit a bit more modestly than what has previously happened in some markets. And that's pretty much because there's still not enough dwellings being built as we saw before. The demand is still quite strong for Australia. Population growth is still relatively strong. The proportion of number of people within houses, the number of people within each house is actually still diminishing. And that means we actually require more dwellings for people to live in as that rate continues to go down. Thank you for the session. I hope it was informative.